Why 90% survive is the wrong number to chase. Anyone who spent time around laundromats, storage units, vending routes, or pest control franchises has heard the same stat. 90% of these businesses are still standing 5 years in. It gets repeated in YouTube videos, Twitter threads, and pitch decks for boring business roll-up funds as if it settles the argument on the spot. The unspoken conclusion is always the same. While flashy startups burn cash and collapse, the unglamorous stuff just quietly works, and quiet work supposedly leads to quiet wealth. The number itself checks out. Industry associations really do report survival rates in that range for categories like self-storage, laundromats, and vending. The problem isn't that the statistic is fake. The problem is what it actually measures and how far that is from what people assume it measures. All a 5-year survival rate tells you is whether the doors are still open. In plain terms, it mostly tells you whether the owner kept up with loan payments and didn't run out of working capital. It says nothing about income. It says nothing about growth. And critically, it says nothing about whether anyone who ran that business for those 5 years actually became wealthier because of it. Staying open and building wealth are not the same accomplishment, and the space between them is far bigger than most people assume when they hear 90% survive and mentally translate it into 90% get rich. Nobody explicitly makes that leap out loud, but it's the implicit promise baked into most boring business content. This piece is about closing that gap, showing exactly where the 90% number stops being useful and what actually separates a business that pays you a living from one that makes you rich. Two owners, same income, very different futures. Here's the central claim of this whole piece. Most of the boring business categories with a reputation for making millionaires will actually just pay you a comfortable living and stop there. Only a handful genuinely produce wealth in the sense most people mean when they say get rich. A single variable determines which group any given business falls into, and it has nothing to do with hustle, niche selection, or timing the market. Imagine two owners who each buy a small business in the same broad category, say service businesses that clear about the same monthly profit. Both net roughly $4,000 a month after expenses, month after month for 6 years straight. Same revenue, same costs, same hours worked, same discipline. On paper, from a spreadsheet showing only monthly profit, these two businesses are indistinguishable. Run the clock forward 6 years and the outcomes are not close. One owner ends up with a net worth around $680,000. The other has just under $250,000, despite putting in comparable or even more personal effort along the way. That's a swing of more than $400,000 between two people with identical cash flow over the same period. It isn't luck. It isn't a secret marketing tactic. It isn't